So Berkshire Hathaway announced their earnings, had their annual meeting, and Warren Buffett, we were actually talking about it last week. When is he going to announce that he would be retiring? And it turned out that was only days away. So we're going to talk a little bit about that and a couple more stocks reporting earnings and take your questions today on Open Interest. Hello, everybody, and welcome. Welcome to Open Mic. I'm Mike Coe, and thank you for joining us. We have a few more big earnings that are going to be coming up this week, and we're going to take a look at some of those. But I think first we ought to talk a little bit about the annual meeting at Berkshire Hathaway, which took place on Saturday. And at that meeting, Warren Buffett announced that he would be stepping down as the CEO of the company at the end of the year. And as had previously been reported, and we had speculated a little bit on this channel, whether or not the appointee, Greg Abel, would be taking over. And indeed, he is the named successor, unanimously approved by the board of directors. He was originally, I believe, he joined Berkshire Hathaway in 2018 and was named the successor back in 2021. But of course, as there have been some others in years past that people have thought might be in line. But of course, we would never know until Warren Buffett made that formal announcement that he was going to be stepping down. 94 years old, and of course, you know, losing a little bit of a step over time, and with Charlie's passing, I guess it's not that surprising. You know, we saw that Warren was walking with a bit of a cane. I think he's mentally still pretty sharp, but it's clear that at 94 years old, he's getting up there. 55 years at the helm of the company, which makes, and that, by the way, is just 2 years younger than the average age of an S&P 500 CEO in this country. So a remarkable and really, really impressive track record. So our best wishes to him. I wanted to talk a little bit about it, though, because Berkshire, I think, is, you know, it traded down today. It's usually not a stock that moves a whole lot. And one of the reasons for that is that Berkshire is about 43% of every share is cash. So they've built, as all will know, a really large cash hoard. We'll call it $350 billion to keep the numbers easy. The company's generating massive amounts of free cash flow. So that cash pile grows each and every day. It's trading at a very similar multiple to the S&P 500, about 24 times forward earnings estimates. It should be pointed out that in Berkshire's case, of course, that when you have a cash pile as big as theirs is, that some of the income they're generating is coming in the form of interest on the fixed income instruments that they have invested that cash pile in. I think full year 2024 interest income for Berkshire was something just north of $6 billion. So if we just take a look at what the company's overall earnings were for 2024, that came out to, let's see here. So gross profit, 106 billion, net income was 47.4 billion. So if we think about it that way, we'll call it 6.3 over 47.4. So about 13.3% of the company's earnings came from the interest that their cash was generating. So here's a way to think a little bit about the company's valuation. You may have heard this said before, but thinking about the valuation ex cash, I think, is a good way to do it. But if you exclude cash, and that cash generates interest income, then you need to exclude that too, to take a look at the rest of the operating businesses and the multiples where they currently trade. So as of today, the enterprise value, which is effectively the value of the business ex cash, is about $577.5 billion. And like I said, full year 2024 numbers were about 47.4. So we'll say 47.4 billion. We'll take away the 6.3 billion in interest income that the company earned. That gets us to $41.1 billion in adjusted net income. And so then we can take 577, let's just call it 577.5 billion. Again, as you know, I like to take these numbers and just keep the math easy. I'm going to round that number up. I'm actually going to round the $41 billion of net income down to 40. One of the reasons I'm doing that is because, due to the fires and a bunch of other things, Berkshire has a lot of insurance businesses, and those have had some setbacks. That means that the operating portion of the business is trading about 14.4 times operating income, adjusted net income for those businesses. And then, of course, you have this cash. So if you're thinking about buying a share, I'm rather surprised by how much it has sold off, because to me, I think it's trading at a very attractive and reasonable valuation. They are going to have to think about what they're going to do to deploy the capital that they have. The company has been known to buy back their own stock when they find that the book value seems attractive. Perhaps it is at these levels. We can take a closer look at that. I'm not going to right now, but it's worthy of consideration. But I think the people that are selling the stock off today are probably, I don't think that's the appropriate reaction. And one of the other reasons for this is it's off about 5%. One of the other reasons is that Greg Abel has been actively involved with operating at least one of Berkshire's core businesses. That's actually how he came to the company in the first place. And secondly, he's been working alongside Warren now for 7 years. And for Charlie, with Charlie also for some period of that time. So my expectation is that they're going to continue to maintain the same approach. And he seems like he has a relatively, simple approach to things, and I think that's the best policy. So, my thinking here is that if you were thinking about buying the stock, I would not shy away net of this. If you own the stock, so if you own the Class A shares, their options are not listed on those. But if you own the Class B shares, there are options listed on those. And, I think at this point, selling strangles against that is not a bad do. And the reason is you're going to generate a little bit of income. Berkshire does not pay a dividend, which makes sense when you think about their business model, which involves acquiring businesses. They're not the type to just simply redistribute cash. Like I said before, returning cash to shareholders will typically come in the form of buybacks if and when they do them. But cash doesn't have that much volatility. So, we've talked about this before. Companies that have significant leverage on the balance sheet, the equity is going to be more levered, and therefore all else equal would be considered to be more volatile. And Berkshire is not, because it's 43% cash, and cash isn't volatile. So examples of how one might think about going about doing that. And you could, of course, also, if you chose, you can also just do buy rights if you're comfortable with that, or if you don't own the stock and you are interested in owning it, you can sell some downside puts potentially, cash covered puts, or even at the money puts, frankly, because I don't think this is an unattractive entry point for the reasons I've just outlined. But I will illustrate each of these so that we have something to work with. So I want the Berk Bs because those are the ones that have options listed. Also, that's, frankly, it would be a conventional options contract on the Class A shares would be a very chunky instrument because the stock was $800,000. The Class A shares were $800,000. Options typically represent 100 underlying shares. So each contract would represent $80 million worth. Very chunky indeed if you were dealing with options on the Class A shares. But so we're going to look at the Class Bs. Like I said, these are typically not going to have a really high implied volatility, nor should they. And that is for the reasons I just talked about. Not a lot of leverage in this thing. So, you could sell. You don't want to buy that. You want to sell that. Anything in this neighborhood, right, I think is probably fine. But what I was actually talking about was if you owned the stock and thought, oh, you know what, I'm going to take this as an opportunity potentially to buy a little bit more, but I don't really know whether, we're going to be facing additional choppiness in the market. By the way, that was, if anybody, it's always interesting to hear his thoughts. And, he had Becky Quick interviewing him. He was just talking about the volatility that we have seen this year, and I think his exact words were, "It's really nothing." He made the point that since the Berkshire partners bought Berkshire, the stock, and they became publicly traded, that he's experienced 3 greater than 50% declines in the stock price since he's been running the company. He doesn't view a 15% pullback to be that meaningful. And, I thought it was good to give us some perspective on these things. But one of the things you could do would, say sell a 20-ish Delta Strangle, something like that against it. You get a structure that looks like this. Okay, so you're going to get a decent little yield here. A 20 Delta Strangle, as we've previously said, is probably going to have about a 60% probability of expiring worthless. Because the way to think about it is a 20 Delta call has a 20% likelihood of being in the money. A 20 Delta put has a 20% likelihood of being in the money. The other thing I would say is that this is not a place to get overly greedy either. This isn't a big yield chase. This is just yield enhancement, recognizing the fact that their operating results are now known and the stock's not particularly volatile, and this is an attractive entry point. So those are a couple strategies I think that make some sense. You could do a cash covered put to enter the stock. You could sell some upside calls, or if your view is kind of like mine, that we're getting closer to a potential buy juncture than anything else, you can actually sell some downside puts where you'd be interested in adding some more stock. Okay, so let's move on. We have some earnings coming up. Finwest. Yes, very good. So I'm going to take these questions a little bit out of order, partially because we have some Berkshire comments straight away. Thinking of selling some Berkshire 440 puts for June. That would be a new low for 2025. Well, let's just take a look at that. So I'll just put these in. That would be, you're looking at the 440s. So here's just one quick observation. Very, very good likelihood that those expire worthless, in my view. Both from a volatility perspective, I think that's true. It's a notable decline, and you're looking at it off of an already depressed price. One quick thing I would like to say, and that is that, so this thing is about, let's just call it 50-50 cash and equity, right? And as I've said prior, when you are selling options, you are taking some form of an equity-like risk. And by the way, when I'm saying it's 50-50 cash and equity, I realize it's 43% cash, but the S&P, on balance, this may surprise some of you, maybe it won't, is actually about 10% net debt. So, if I just call it even equity for Berkshire and call it 50-50 cash and equity, it actually works out about right. So if I think that I'm looking for, let's call it 12% annual returns for equity-like risk, that works out to about 1% per month. Now, in the case of Berkshire, because it's about half as much equity and half as much cash, well, maybe I'm not going to be quite as insistent. So let's take a look at what you're getting here. On this trade, you are getting $2 on a 440 strike. Okay, so $2 on a 440 strike is about 50 basis points. And that's 50 basis points over the course of 46 days. So that's actually less than 0.5% per month relative to the risk. Again, very high probability that you're not going to be assigned on these. And partially because it is so much cash, and because we've had this pullback and all that, I might be looking for a little bit more premium myself. My own benchmark on this would probably suggest, based on the math that I just gave you, which is just back of the napkin types of stuff, that I would probably be looking for an option where I could get something in the neighborhood of $3 or so. So that's going to take me up around here, probably to call it the 460. Still very, very low probability of assignment right? So you're going to collect a little bit more than 50% additional premium, still a 93+% chance that you're not assigned on the stock. Even if you are assigned on the shares, you're going to end up buying about $45,000 worth. 100 shares will cost you about $45,500, $45,600. Not bad. So, I would probably bump it up a little bit, but, to each their own. Everybody's going to have a slightly different sensitivity. I will tell you, just anecdotally, I know of a registered investment advisory practice that's based in the Atlanta area. It's a Morgan Stanley team. I know one of the technologists that supports that group. They do a lot of options overlays. My understanding is, I don't have all of the particulars, but my understanding is they are one of the most active. And I'm vaguely familiar with some of the things that they do and look at. And because most of their clients are just straight long equity, and they look at options overlays primarily as a mild revenue enhancement, they are exceptionally conservative with the strikes they choose. And they will do more FinWest like what you are suggesting here. Oh yeah, so you wanted to know what the earnings looks like for it. So let's just do this. We'll go to Ticker Explorer. Go over to the earnings section, and we can take a look at the history for BRK shares. Hopefully. No data available. Did I do that correctly? Maybe. Yeah, that's interesting. It's not coming up. Let me try to adjust the number of quarters I'm using here. It is entirely possible. I'll have to check, but it is. Yeah, it's not pulling up the. Let's take a look at the A class. Do they have the A shares in here? No. Okay. So that I'm going to have to put in a ticket. Yeah, I'm going to put in a different one in just a second. But since we're trying to answer the question on Berkshire, we're going to get to the technical issue there in just a moment and just make sure we can see. So this is a history of the earnings-related moves for Berkshire over the last several years. So you can see that the average move is only about 1.8. So the 5% move that we're seeing today is well above average. Their next reported earnings are going to be on August 4th, which your June options would not capture. If you are looking to manage your strategy such that you initiate this trade, this is a good point. So if you sell that option for, it was, and I think the one you were looking at was about $2. This is an important point. It is not as if you're going to have to wait all the way for expiration to be able to buy this thing back very cheaply, right? Because what actually is going to happen is this thing is going to go down in value. As expiration approaches, it's going to accelerate. It's going to be a very cheap option. You'll have an opportunity to cover it back. So for me to describe it as, we'll call it a 0.5% over 45 days isn't entirely fair to you. I mean, by saying that, because the truth is the decay is going to cause most of that options value to go away well before the actual expiration date. Again, that's partially because this option is so far out of the money. And that's another thing to think about. So, when you're dealing with options that are very low delta, so those 440s that you talked about, those are 8 delta, and the ones that I'm talking about, maybe the 460s, are only 12. These sort of wing options, a lot gets sucked out between, we'll call it 6-7 weeks and 3 weeks or so. So in a 1 month period, much of the premium here is going to go away, and those options probably should be covered because relative to the price of the stock, it's not going to be worth wearing them. So one way to think about this as you look ahead to the August earnings is imagine that you're going to be managing this position not on June 20th, but probably on June 1st, or what actually is the date? Let's see here. So that's probably going to be, you're probably going to be thinking about rolling these on May 30th, actually. So that's the last Friday in May. I think most of the premium will be gone by then. So, and that's actually, so as you guys think about not just Berkshire, where I like this trade, but any stock, right? So when most of the premium is gone, you should cover those, because at that point you're just, we'll say you're picking up pennies or nickels in front of the steamroller. Very good chance that you don't get hit, but the consequences of getting hit are so severe that it's not worth sitting around and waiting for it. Besides which, your capital is better deployed elsewhere. If you're short naked puts, it's going to have some capital requirement, not huge, but it's going to have some. Migrate that strategy to something that's actually paying you a little bit more. But no, I think that strategy is fine. I probably would bump the strike up a little bit, but there you have it. Finwest says, I usually close my positions for a 50% profit, or I roll it 21 days, give or take. Yeah, exactly, right? My guess is, those probably are not too far off of one another, but in terms of time, a week or two, whatever. But yeah, I think that's a good strategy. So, and Alex V, actually, it's funny, he's talking about a little bit about the strikes that we're looking at here. So this is also true. If you're looking just at the technicals and you're thinking, can it retest these levels? Let me blow this up. So can it retest these levels from just recently? And the short version is, yeah, of course it certainly could. If you're of that view, if yours is a short-term, technically bearish perspective, and you own the stock, but would be willing to add, but that's the level, then what you would do is you would actually sell the upside call against your stock now, and then as time passes, if it does get down there, I don't know whether it will or will not, but if it does, then at that point you could say, okay, now I'm going to initiate a downside put sale. Now, depending on the amount of time that takes, that may or may not be the June option that you will be doing. So, for example, if it takes, say, 2 weeks for it to trundle back down to $4.75 a share or thereabouts, maybe you're going to be looking out to June month ending or July options by that time, depending. Sort of trying to find that sweet spot where you're getting a decent amount of premium, but and don't just always annualize it, because if you annualize a daily number, you can end up taking quite a lot of gamma risk, and that's not really what our objective is, particularly if you're dealing with an underlying where it's probably more of a long-term investment, which I think Berkshire could safely be characterized as. Okay. All right, so let me sort of now switch gears and go to, and it's kind of related actually. So Steve Garcia, hello from sunny Marin County. Well, I'm in sunny Marin County, and it is indeed pretty sunny, and it's getting a little warm. It's a little warm in here. It didn't fire up the air conditioning just yet, but I'm on the cusp right now. I notice the dog is in the backyard, and she's in the shade with all of her fur. So, yeah, it's getting a little bit toasty. And we're close to the bay, so very close to the bay. You could probably hit a driver into the water from here if you really got a hold of it. Okay, so I've held Progressive for 3+ years now. It's 20% of my portfolio. Should I rebalance? Insurance may stay strong amid tariffs, and Progressive is a standout company. So, look, I like the business for sure. It's a great cash flow generating business, and I think, let me see, do I have, let me see if I can. For some reason, I thought I was starting to take a look at it, but let's take a quick peek here. And you know what? I should probably, let me go over here. I'm going to pull this up in UnusualWhales as well. Okay, let's have a look at their financials, because this is really the story as far as I'm concerned. Yeah, so we have revenue and net income over here, and actually I had done a quick calculation somewhere of the compound annual growth rate in these things, and let's see if I can do this. So here we are. So revenue, compound annual growth rate for Progressive on the revenue side, 14%, and about 8% on the earnings side, partially because we had that big sell-off, that big dip here. But that's okay, In other words, we probably want to take a look at something over a longer term trend and grab some of those cycles where you have these big setbacks like we did during the during the pandemic period here. Let me see how far back I can take this. How far will it let me go? Yeah, so I don't know whether it can keep up those kinds of numbers. It would be awfully nice if you could invest in any business that could. But what we're looking at here are solid double-digit compound annual growth rates for both the top line and the bottom line. Still forecast to get that. $15.75 a share is what they're looking for full year 2026. Not much growth year on year from what we're getting this year, but still, let's just take a look at this year's numbers. So 282. So we're looking at 18 times with a double-digit top-line growth rate. Yeah, I think you're good there. I still like it. And it is a business that it's a business that I don't really see necessarily going away anytime soon, right? So I think there's a lot of question marks about, obviously, tariff concerns. Tariff concerns are a little bit different. Those are, events that are related to a business that can impair or enhance it, depending on the nature of it. But the other question is, is a business in secular decline? Are you dealing with a buggy whip business? Are you dealing with, an early 20th century rail business? Are you dealing with a bricks and mortar retailer, a Macy's, a Nordstrom, somebody that operates as a anchor tenant in a mall? Those are businesses that are facing real secular challenges. And now that we have all of this advent coming from artificial intelligence, I was talking to Jay, producer Jay, who is actually producing today's show, about this. What industries are not going to be affected by artificial intelligence, and what occupations? And I think there's very few that we can identify that aren't going to be impacted in some way. But are there core businesses who are likely to be able to benefit and probably don't see a huge setback? The insurance business seems like it's, I'm not going to say it's completely immune, because we have to imagine, for example, what's going to happen on the auto side as cars become self-driving. So are we going to have fewer accidents? How's that going to affect the amount of premium? So if you have fewer accidents, maybe the premiums come down. Is their payout ratio going to be lower, though? Are they going to be able to maintain the same margins? So even if the top line premiums drop as a byproduct of safer driving, which is a benefit, we'd all be happy to see that. We'd all be happy to see lower insurance premiums, all else equal. But, do the economics of the business remain relatively the same? How much of the actuarial work and things like that are going to be supplanted by newer technologies and techniques and approaches? And, how's that going to play out? We can't be sure, but in general, it's not a business that's going to turn around and go away in the near term, and generates, typically these businesses generate considerable amounts of cash, which is obviously an attractive element. Worked out pretty well for Hank Greenberg before his successor blew up AIG, and obviously it's worked out very nicely for Berkshire Hathaway. Okay. So, Bunny23, hello, Mike. What kind of option strategy and duration that you like to use for SPX options? Thank you. Okay, so that depends on the circumstances. When I've been doing these live streams a couple times a week for quite some time. I don't know how far back in time it goes, but I do know that I was doing these back in early 2024. What was going on in early 2024 that really caught my eye and impacted the SPX strategies I was using? I'll tell you. So in early 2024, one of the things that we saw was that the implied correlation, that is to say the relationship between options on the index, so that could be SPX or SPY because they're basically kissing cousins, or the Qs and their constituent stocks, these things were at very, very low levels. What I mean is that the premium on SPX options had gotten very cheap relative to the constituent stocks. So let me see if I can go back 2 years and we can take a look at that. So I want to get rid of the noise from the realized volatility. So we're just going to look at this one line. Let me blow this up a little bit. Okay, so we're getting back into this time frame over here. Let me draw a line of what we're looking at here. What I was looking at. So when implied volatility is very low, as it was in here, this period, early 2024, I want to own vol in SPX. What was I doing at that time? I was actually buying strangles, 20 delta calls and puts or thereabouts. So delta neutral on the SPX side, slightly long delta overall, as we typically would be because we're long underlying stocks, 30 to 45 days out. And then hedging it, delta neutral. So basically just monitoring my gamma and I had a target delta, but whatever your target delta is, as what that meant was that as the S&P rallied, I would sell some SPY. I was using SPY to hedge my SPX strangles because they cross margin. At least they do on my platform. I'm sure they do on yours too. Anybody with CPM probably works this way. And then I would buy some on the way if it came down. The idea was that if we got some kind of an exogenous shock, I was going to basically have some kind of shock insurance, and I was going to pay a little bit of that back each day by hedging my gamma. And I'm trying to remember, and if we go back and watch those videos, because I was kind of talking about what I was up to in basically real time, I was probably covering those with 2-3-ish weeks ago. So probably almost the exact opposite of, we'll call it the normal short strangle strategy where you're selling 20 delta strangles. Now I was still selling premium, it should be said, in the single stocks. So I was buying it in index, selling it in single stocks. And what's interesting about this is that is 100% the opposite strategy that when I was at Gateway Partners and that Bluefin also did, so two prop options trading firms that I worked for late 90s and early aughts. Our conventional strategy was the exact opposite. So we were what we call dispersion trading, long dispersion. In other words, you are expecting the returns of the individual constituent stocks of an index to be more dispersed. That is, that the stocks are going to go in different directions. Earnings comes out for stock ABC and it goes up 10%, comes out for DEF, it goes down 10%. The index doesn't do so much, so you capitalize on owning premium in the single stocks and benefiting from idiosyncratic events. The reason I was doing it this way in 2024 was, you can see on this chart, one, implied volatility for the index was quite low. So I didn't really expect SPX options premiums to drop considerably from this level. This was basically the lowest level that we'd seen in the post-pandemic era. The other thing was that the relationship between SPX options, and you can do this any way you like. You can try to do it in a really sort of mathematically robust way, we'll call it that. But if you just simply look at a ratio, so let me give you an example. You just said, okay, well, the biggest stock in the market at the time was maybe Apple, let's say. And so what I was interested in was the relationship between, oops, this is historical. I don't want that. Okay. So I'm looking at the relationship between these two, right? And I'm saying, okay, well, this is very low, and that spread looks like it may have widened out a bit. All right. So we can look at this as a ratio. This is a decent way to look at it. And I'm thinking to myself, okay, this is getting a little bit extreme here. Okay, so I'm deducting this from that, and you can see that right around this early 2024, the relationship between the volatility on SPX to Apple, one of its largest constituent stocks, was basically, at an extreme. And I was thinking, you know what, normally everybody prefers to be short index vol, long single stock vol, because that's a situation where you can get these windfall profits. You don't typically get a windfall profit going in the other direction. But when things get blown out enough, it's worth considering, what you might do. Take a look at where we are now. And you can see, and this is probably not that surprising, that now the trade was actually setting up the other way. And what's interesting about this too, I encourage you to, there's a lot of good free resources. Mandy Shu, I previously have mentioned her. She is effectively the chief derivative strategist at SIBO, a role she previously held at Credit Suisse, if I remember correctly. And, they track this kind of stuff. And you can actually, it's free. You can just go to the SIBO website, put your email address in, and you're going to get this, and they'll send you all kinds of fancy charts. And among the things that they like to talk about are the relationship of options prices and the behavior of the underlying stocks to the indices of which they're constituents. And when those things get extreme in one direction or another, that can help you navigate whether it's better to be short index or long index vol, short single stock or long single stock vol. And when you get this kind of a situation, now you want to be short index and long single stock. And what this is basically telling us is that what happened this year and at other, like over here, you can see this big spike. Let me just blow this up so we can see it a little better. So you see this right here in August. Last August in 2024, we had a big market washout and correlation jumped up. When correlation jumps up, typically options on the indices is going to rise, and it's going to rise faster than it does on single stocks. That's the time that you want to be a seller of index vol and you want to be a buyer of single stock vol to capitalize on that. And then as the volatility normalizes and implied correlation comes down, you're going to have a tailwind, and you get to own volatility on single stocks. And that's the happiest place to be, because you never have one thing sort of blowing up in your face. If anything blows up, you usually win because you own single stock vol. That's where the blow up is going to take place. What's an example, actually? We were just talking about this, SKX. Although, so Skechers agreed to be acquired. It's a private transaction. It's a takeout. This is a little bit curious because, unsurprisingly, there's already been a legal announcement made. So we'll talk a little bit about what the standard thing to do in a case like this, what the ARBs do, the risk ARB guys. So this is where the stock is now. The takeout price is 63. This is well below where the stock was even earlier this year. So, it depends how shareholders think about it. If they think about it only because they bought it this year and they're saying, hey, wait a minute, they're selling the company for less than I paid for it, I don't like that. Well, I can understand that perspective. But another way to think about it is, okay, well, the stock is still substantially higher. So if we take a look at this chart and you say, okay, well, what about that $63 price target? What am I talking about? $63 takeout price. Well, we can see that's not far off of its all-time highs. There's probably going to be a little bit of squawking about this one. Okay. We're going to get back to some earnings, but I just want you to, if you take a look, you're going to see there was a ton of options activity in Skechers today. And we're just going to talk very quickly about what the risk ARBs do. Who are the risk ARBs? Risk ARB players are typically people who play in the corporate action space, who are trying to capture, oftentimes with a little bit of leverage, the last little bit of premium in an anticipated deal. So in Skechers' case, take private, all cash, $63 a share. So what you do is you buy the stock and then you sell the upside calls. So for example, if the deal goes through at 63, these 65s are going to go out worthless. No big surprise. These were the most active contract, traded almost 50,000 contracts. And the average price of these suckers was 10 cents. And you say, well, who wants to sell it for 10 cents? Well, if you're buying the stock and you're using leverage to do it, so you own the stock, let's see what the VWAP on this thing was. 61.60. Okay. So you're expecting to get $63 a share out of a $61.61 purchase. That's only 2.25%. You collect another dime over the 61.60. So that's another 16 basis points. Hopefully you get 2.5% between now and the closing date. And then you use a little bit of leverage to do it. I actually was looking at this thinking, is there some chance? It's a friendly deal, so probably not. But is there, in a situation, if this was an unsolicited, not friendly deal, then you're more likely to expect that a bid could rise. Friendly transaction, there's kind of an agreement, so it's a little bit less likely. But, I did look at this and I thought, would I think about buying a longer dated 62.5 strike call on the off chance that people who own the stock at 65, 67 bucks start balking and start trying to squeak a little bit more out of the deal? Maybe. We also want to take a look at things like the company's free cash flow, because from a private equity purchaser's perspective, how's that going to stack up? So they got a little bit of debt on here. We'll call it $300 million in free cash flow. So, I don't know. I don't know how much more room they would have to increase this bid, because you have to imagine, look, they buy the company. They need the company to finance the purchase, right? So, anyway, it was an interesting aside. So we'll leave that alone and move on. Okay. Fed's meeting starts tomorrow. Should we hedge? I'm not expecting a whole lot. I think most of what's going on is probably priced in. I think we have an increased recession risk. That's a potential tailwind. In terms of Fed action impacting things. But, in terms of should we hedge, one of the questions is, what are we hedging against and how much do we have to pay for that insurance? So certainly options premia have fallen pretty significantly from these highs that we saw. They are still well above average, right? So maybe you're hoping to pay in the teens. Now we're going out a year and you can see we're still above 20 for a 3-month at the money option. I don't know that you need to get a 3-month at the money option. Not much cheaper for the shorter dated ones. But you could buy some put spreads or relatively tight put spreads to hedge it, as kind of like a homemade binary option to the downside. But we are a little bit off the all-time highs, so, and I think that probably net of some of the economic data that we've gotten and falling oil prices are helping too. That helps a little bit on the inflation front, might give the Fed a little bit more leeway. So, yeah, I think it's fine, but I would use spreads to do it. Depending on how much bandwidth you have, you might even consider ratioing those a little bit, like a 2 to 3. So, selling one extra downside put if you're trading SPYs against straight up 1-by-1 vertical. Just to help do a little bit more offset for the slightly above average. But I guess that what that is telling you is that while I don't necessarily think that we're completely out of the woods and that we could see a pullback, I feel like a lot of damage was done already, and I'm a little bit less concerned about that real shock impact at this point. Okay, so I already addressed the 440 June spreads in Berkshire. Steve, you sold a few UNH May 400 puts when UNH was around 420 or so. Stock price is now flirting with that strike. Another 25 days to go. Yeah, so now you're effectively in a buy, right? On United Health. And let's see, you said these were you say it was the May's or the June? Sorry. May 30th, month ending. Okay, so let's take a look at those. So month ending, 400s, $11. Yeah, you're basically right on the strike at this point. So 2.75%, 32 vol. Yeah, it's not a bad sale. You may end up going into the wheel strategy on this one, which is that if you put the stock at 400, we'll call it 390 if we're thinking about it right now, for those initiating the trade, your effective purchase price would be about $390. So that's the strike less the premium that you collect. Yeah, not terrible, but you might end up just doing the wheel to sort of milk your way out of this a little bit in the event that it goes down a little bit further. So it gets down to 385. Then you could probably look to sell, a 1 month up to 6 week 395 call against it, something like that. So actually, when's their earnings? That would be the exception I would make, is try to avoid that. So their next earnings are July, right? So, it's possible. I mean, there's probably, a 40% chance that if you just rode these all the way in that you get assigned. And then you could, but just sell premium that doesn't capture that event. We'll see. Of course, there's a chance that the implied move is way outside, but it's a little too soon to know for sure how attractive that's going to be. First of all, you're not in that position yet, but yeah, I agree with it. This is a company, as I've said many times before, I've long liked it. It's trading cheap right now. It does seem like they have under a little bit of pressure. People taking a look at things like their Medicare plan, Advantage plans, and things like that a little bit more closely. But still, a great operating history and best I can tell, a great business. Previously mentioned my former colleague Cheryl Skolnick moved on and joined that company. Okay, let's see here. That was United Health. GLD, Java Mocha Frappuccino. Your opinion on GLD? Well, my opinion on GLD is really my opinion on gold, and I think everybody should have an allocation to it. Anybody who followed my sort of acronym for 2024 will know that that was a part of it. That was BRAVE. The A was for AU, Anglo Gold Ashanti. And this year, those who are watching the live stream know that it was rising with 2 Gs. One of those Gs good, one of those Gs not so good. The not so good one was Alphabet. GOOGL was that one. But the other one was GLD or gold. Either way you like it. So I will say that, we obviously had a heck of a run in here. And so it didn't surprise me terribly that we have bounced off of that. But, having a long-term allocation, I think, to this makes some sense. With one caveat, which I had previously mentioned, when the market really rolled over, let me add that in. I'll just put SPY in. Why not? So when the market kind of rolled over and we had gold reaching its highs here, one of the things we talked about on this live stream, some of you may remember, was that I said, this, and actually Mark Guthner also made this point. So I'm going to highlight this so we can see this chart. So here we're looking at the S&P. Here we're looking at gold. The idea was that, the way a lot of fund managers, the way we would often take a look at these things, and sometimes it's not just discretionary, right? So when I was running a 40 Act fund, we have specific regulatory requirements with respect to the amount of concentration we can have. So it's not just a free-for-all. You just say, I get to pick this stock and that stock and buy however much of it I want. No. Less than 50% of your fund can be concentrated in positions, each of which have more than 5% of that fund. Now, you can hold those positions if they go above it on their own. You can't initiate. So, for example, I buy a 4.9% allocation of the fund into a security. That stock rallies by 25%, right? So it went from almost 5% to now over 6%. I don't have to sell it, but it wouldn't necessarily be uncommon for us to do that anyway, because we don't want to have excess concentration in single stocks. And I'll tell you a very personal story about this, and I'll even talk about the stock that impacted our decision about how and when and if we were going to readjust. So we owned some FedEx. See if I can remember this. It was probably back half of 2022. So let's just pull this up so we can just talk about this a little bit. My pain my hard lesson learned doesn't have to be yours. But this was a situation where we had added some FedEx. We had a larger position than we might normally have had. And the stock rallied going into the print. Is this when it was? Yeah, it was probably right in here. Well, I don't see much of a rally, so I'm trying to remember how long I held that one. Probably be able to figure it out. Let me go back to the beginning of the year. Yeah, so I probably bought the stock. You know, it was probably in and around this period here, early May-ish. It was close to the lows of 2022 that we owned it. And the stock had rallied considerably. Now, this doesn't look like it based on this, because this is the part that really stung. But maybe we held it longer. All I know is that we had a pretty good-sized position, and it got bigger because the stock rallied. And we thought about it. You know, we thought about, you know what? Do we want to sell this back off so that we own roughly what we were allocating to it to begin with? So we can probably do a little bit of this work. But if we bought it in here, yeah, the stock was up 25%. So if I bought 5%, now I'm up in that 6.25 range. And we debated it, actually, because now it was one of the stocks that was in that top half of the bucket that we have to monitor fairly carefully. So things you have to monitor in a 40 Act fund: how much do you own of financials? Because a 1940 Act fund is itself a financial, and so you cannot have overly concentrated positions in investment companies. We actually got into a debate about whether Berkshire at the time was a financial company because they have a lot of insurance and stuff like that. Any case, so we had this overly large position. It had become outsized. We did not sell it. And then the stock sort of trundled back down. And then we had this late 2022 earnings print that I'm showing you right here. This was a huge move down. It was, again, I'm just going off of memory, but I want to say that this decline, which was how much? It was 25% down gap. I think it was like the worst earnings performance for FedEx in 30 years. It was longer than I'd been in the business by a lot that it had ever done anything like that. And I remember we had an internal conversation. We said, we're not getting into this situation again. That's just not going to happen. If a position has the kind of appreciation that we saw here, we got 25% appreciation in 42 sessions, and now we're above our chosen allocation. We're going to take some of those profits and we're going to allocate to something else we liked, because who are we to say, you know, we absolutely bottom ticked it or top ticked it? We're estimating what these companies are going to make over the next 5 to 10 years. I don't know that number with any remarkable precision. It's going to be an educated guess. And it is also fairly clear that we were not alone in thinking that the numbers were going to be better than they were coming into this next earnings. So why do I bring all of this up? Well, as you look at this gold situation that I was just outlining, what you could seriously think about, and what I think you should do, is rebalancing when you get into this situation where you have gold has had this huge rally. And I think you should, I'm not saying don't own it. I'm just saying that if it was 5% of your portfolio, what happened here? Well, the broader portfolio, that's this, has now dropped 15% peak to trough. Let's just say everything was hunky-dory back right here when the S&P was at its highs. Okay, so now the market's off 18.5% into early April, and gold over that exact same period, I'm going to try to, all right. So gold is now up 6.4%. So between the two, it's more than a 25% differential. Well, what might you think about doing? You could say, well, I'm going to sell off 20% of my gold position, get back down to 5% or just below, and I'm going to reallocate that to equities, which has now become disproportionate. Now, the truth is that number is going to be actually that spread's actually going to be more, because it's not just that this thing has appreciated and therefore become outsized. The other part's been going down. So it's actually that, you know, it's a big swing that's taken place. And then what ends up happening is, well, you'd have a less exposure to this, but you'd have much more exposure to that. And this is going to smooth out your returns, and it's going to help you avoid overconcentration. Just something to think about. It's a very standard thing. Most pension managers, I have not managed pensions unless pensions were invested in our fund. I don't know about that, but it is a standard portfolio management approach. And it's one that if you're going to be thinking about it and adjusting dynamically, it's worth thinking about. Okay. But yeah, like gold, I don't think there's any reason, but I also like Bitcoin, any kind of hard currency. I mean, the dollar's been mostly devalued since 1913. And here's another thing. It's been pretty much mostly devalued since 1971. That was when Nixon suspended the convertibility of the dollar to gold. I'm not trying to be some wild conspiracy theorist or anything like that, but the fact is that fiat currencies lose their value over time, and gold typically doesn't. Okay, so insurance are now deploying apps that track driving behaviors and use AI to calculate current risk and predict future risk. In theory, it's better margins. Yeah, in theory, so I would tend to agree with you, but it's a margin on a percentage basis if premiums drop. Something to think about. Mike, I hold a big position long-term on SOFI as a growth stock. I sell puts and calls as well on it. Good. What's your view on financials and fintech in the short term and the midterm? SOFI, I have to say, I've actually been pretty impressed, more impressed with them over the course of the last 18 to 24 months. I have no unique insights as a result of what I'm about to say right now. Happen to be friends with a fund that is one of the early investors. They have a board seat at SOFI, and I like the business. I like what they're doing. That is the future of the business. This is an interesting thing. So this is unrelated to SOFI. It's kind of more related to state of the consumer types of stuff. One of the things that I find interesting was Capital One announced that they were going to do more in the subprime space. And that I thought was kind of interesting because, as we've previously talked about on this channel, consumers are in considerable distress. We see auto loan delinquencies are higher. We've seen loan approval rates declining for home refis. We've seen auto loan approval ratings dropping considerably as well. Within certain demographics, we've seen the cash balances drop considerably. All of these things put together don't really tell a great tale. Capital One appeals to a slightly different demographic than American Express does, for example. And so you would normally expect in an environment like this that AXP over COF would be the way to go. But I found that very interesting. And you also would expect to see, and we have seen, some loan loss provisions rising. But, there has to be a reason why they're going in this area. And one of the reasons I would imagine that they're going in this area is because we have finally seen some broadening out in credit spreads. Some of the subprime stuff, maybe you just weren't being sufficiently rewarded to take those kinds of risks. But if you blow out spreads by 150 basis points across portfolio, and they've done more modeling on this than I have, that might indeed be more compelling. So another way we can take a look at this is we can compare sort of like a high yield portfolio versus, say, an investment grade portfolio. Now, this is an imperfect comparison, if you will. And one of the reasons it's imperfect is because LQD, which is the investment grade, first of all, there's a decent bit of duration. I think it's 7 to 8 years on LQD, but about 50% of LQD's constituent securities that are inside that fund, the last time I looked at it, I didn't look at it today or even within the last couple of weeks, but the last time I did look at it, about 50% of the constituent bond holdings in LQD were the lowest investment grade. So they were just one notch above junk status. You know, big allocations to things like AT&T bonds. That would be an example of something. Actually, I think they actually got a credit rating upgrade, so they might be 2 notches above junk now. But so this is not the perfect comparison as we look at these. And obviously, when you see this kind of compression, this thing coming down like that, that's basically telling you that LQD is that's underperforming there, and then it's outperforming here. So this would be spreads increasing over here, decreasing there. So we were at very low spreads earlier, and then we've got Capital One and others. So, but I think SOFI is in a good spot in terms of their business. So I kind of like that. And actually, let's take a look at the premiums too. Let's see how those are stacking up, just in terms of your put and call selling activity. Let's go out a little bit in time. Well, this is kind of interesting, kind of a big spread there. So this must be event driven, I'm assuming. There it is, yep. So what am I looking at here, just so that you guys have some sense, because these probably just look like squiggly lines. And what was I talking about event driven? That's this, right? So we had an event in here that caused a big spike in volatility. If I exclude that, then the orange line is what the stock is doing, and the white line is what I'm collecting right now. This is the money I'm being paid to take on orange line risk. So what we like is if the white line is comfortably and consistently above the orange line. That means you're being well paid for the insurance you're providing. As an insurance seller, as a premium collector, you are selling insurance on the underlying equity, whether up or down. And we're just trying to say, okay, well, you know, simple actuarial approach, is that a good bet? And what you would do, you see that here it clearly was not a good bet, but that was idiosyncratic. We had an event, probably was earnings or something like that. That was not a really big move there. So, it was probably, prior one. Probably didn't go back far enough. But no, I do like the strategy. And as you were just seeing, if we exclude that one isolated instance, it seems like the premiums, they're kind of chunky. Don't just chase premiums. I just want to make that clear, because you get lured into, oh, wow, there's a straddle. It costs 20% of the stock price. I'll sell that. Well, sometimes that's well deserved. People who are selling options on GameStop would have learned that lesson very much the hard way. So that's the sort of critical determination you need to make in each case. SMCI pre-announced short of expectations, stock sharply down. You know, this is a really interesting situation. Yeah, so let's take a look what's going on here. And where's the stock right now? Where's the stock trading after hours? Yeah, I have a stale print here. That's not updating. That's not what I want. Let's see what we have. Am I missing something? I must be. Did I? All right, so forgive me. Expected to report. I'm not, okay, I apologize. So somebody's got better information than I have. Tucker D. Dog has better information. You guys are welcome to chip in. Why is this not on my wire? Good question. Absent. Palantir reported today down. Yeah. Sorry, Tucker. Okay, you're talking about last week. Gotcha. Okay. It's like this. I thought you were talking about some announcement that just happened, because they were supposed to be coming right up. Okay. Thank you for that. Absinthe, Palantir reported today down 10% after hours. Palantir's biggest challenge, first of all, I'm very interested these guys, and then also, you know, I like the things that they're doing. I think it's going to continue to expand. Their biggest challenge is the following, and that is just simply one of valuation. You could say a 10% drop. Oh, well, is that substantial? Well, is it? I mean, we're talking about a $292 billion business. That is, so we'll go to 3.7. That is 79 times revenues. That's a big number. Now, of course, this thing is growing like a weed. And, you know, I kind of expect it to continue to, so that's understandable. A 10% move, I realize that feels like quite a lot, but when you're dealing with something as richly valued as this is, it's actually not that substantial. Yeah, the valuation is crazy. That's yeah, you're talking about 80 times revenues, 160 times earnings. It's the real question is, do you believe that the double-digit growth rates that they're seeing and the margins that they're also seeing, which are very substantial, by the way. I don't know if you're seeing this. Let me bring this back. So the net income margin, this is net of tax, right? 38%. That's a nice business. If you get into a business where 38 cents of every dollar you have converts to net income for shareholders after tax, we like that kind of math. If it is growing at 30% a year on the top line, we also like that kind of math. It doesn't take a hugely long time for suddenly this to look like a great valuation. The problem is, and this is the bad habit of almost everybody on Wall Street, and even sometimes myself, which is we take these prior data points, and I think it was Mark Guthner last Friday who was saying, you know, what do Wall Street analysts do? They take a bunch of data points, well, they kind of line up. You use your ruler and whoosh, draw a straight line to the moon. You know, if something is growing at 30% a year, that compounding turns into real money really fast. The question we have to ask ourselves is that actually going to be realistic? So what would be realistic for this business where suddenly it becomes exceptionally cheap? Well, if it was growing at 10% and it was trading at 25 times earnings, that would be a very attractive number. So if we think about it that way and we say, okay, well, assume that the growth rate slows down once it gets to, call it, $11 to $12 billion in net income. But, you know, it's really, I'm not saying it's pie in the sky valuations. All I'm saying is that things get very murky and fuzzy when we get that far out, because what you're talking about is a 7-fold increase in full year 2025 net income, you know, for this thing to seem like bargain basement cheap. There's a lot of good news priced into it. But there's a lot of volatility priced into it too. We can see that in options prices. Markets anticipated a give or take. Well, let's take a look. Let's take a look at what UnusualWhales has to say. And actually, because I didn't go back to this, somebody asked me to, and I didn't. Asked me to take a look at the wanted to see whether the earnings calculator was just off for Berkshire when I was using this earlier, or whether it was just this. So let's just find out real quick. We'll go to we'll just go over here to earnings and throw this in. Nope, it was just Berkshire. That's actually not that surprising. 2 share classes, probably, you know, also because the ticker symbol tends to be a bit weird when you have that. So you have 2 share classes for Google / Alphabet too. You have GOOG and GOOGL. That's a little bit different than when sometimes it's slash, sometimes it's a period or whatever. And so a lot of systems, you know, it's not until somebody tries to put something in that you realize you got some kind of an issue here. So what do we got for an implied move? 12.2. So that's actually a 10% move is inside of that. So pretty accurate. We'll see. And yes, to your point, so Absent just follows up by saying it seems like in the past, the volatility has been greater than that implied. It looks like substantially greater. In fact, only 3 instances where it was not greater out of the last 11 reported quarters. And in 2 of those instances, it basically moved the exact amount implied. So owning the straddle has proven to be a very nice do in Palantir over the last 11 quarters, because you would have lost money on this one, you'd have broke even on these, and you'd have made money the rest of the time. That's a pretty good track record for owning premium, which isn't necessarily. This is one of the reasons. This is a really good reason. Okay, so what I was talking about before, not just selling covered calls going into an earnings print and doing that big yield chase, because these premiums all probably seem pretty chunky, right? So you see these implied moves. Those are 1-week implied moves. What do we know? The earnings move is going to be approximately the value. The implied earnings move for the week is going to be the approximate value of the at-the-money straddle for that week. So if you were looking at this and saying, oh, well, these are big premiums, let's just say, I don't know what the average number is, 12. What's this smaller one? 10, 11, 12. Here's another one that's smaller. That one was 11. So we're dealing really with, on average, expected moves that were 12% or more. So, if you think about it, you could say, well, if I bought the stock and sold the at-the-money call, I'm expecting to get 6% in a week or more. And that probably sounds pretty good, right? You're thinking, 6%, compound that times 50 weeks, and wow, you'll be rich in no time. Be careful when you see these really big implied moves, just trying to chase that. You're better off, in most instances, taking lower premium between events than trying to chase the high move of events. And Palantir is certainly a very good example of that. Okay. So let's see what else we got here. How far? Oh, I see. We've already chewed up more than an hour. I see there's a couple more questions, which I would love to get to. Unfortunately, I have a meeting in the city that I have to get to this afternoon, which means I don't have a whole lot of time to go over today. So what I'm going to do is I'm going to screen grab some questions that we have here on MicroStrategy and Bitcoin, which is a real area of interest of mine. We actually had Darkside on several weeks ago, and he's going to be launching a volatility hedge fund on this space. He's probably conducting spaces on X right now. If you have interest in cryptocurrencies and Bitcoin in particular and are interested in this, I think he actually talked about a long Mr. Short marathon trade and some other things. So Darkside on X, excuse me. And I'm going to get his actual handle. I think, is it just Darkside? Let me see here. Bear with me 1 second while I just make sure I have this right. So I'm going to if I'm going to ask you to say, oh, maybe here's somebody you could follow in the space that okay, so Darkside's handle on X is at Darkside2030 _. At Darkside2030 _ on X. And this guy he has spaces on X all the time. I've known Scott, that's who that is, for quite a while now. He has developed other fintech businesses. He's a real entrepreneur. He's actively engaged in the space. He's made 8 figures in crypto as a crypto investor himself, in addition to a lot of his other very successful entrepreneurial endeavors. But he is a real student of the space. And so if you're interested in learning more about it, I encourage you to follow him, and I will address that hopefully on Wednesday. The other question that was being asked, CEP. So we'll try to get to that. And yeah, I think we're going to wrap it up there. And this is an interesting thing too. I'm just going to throw this up here because I've talked about this in the past, MicroStrategy, with respect to, and look, two of you are trying to jump in here. So on this issue, so trying to replicate MicroStrategy, you're talking about the premium to their book value, which is the amount of Bitcoin that they hold. But of course, the reason to trade MicroStrategy is not just the book value of the Bitcoin on their balance sheet, but also the net accretive effects of their, call it, creative financing activities. So they sell 50% upside zero coupon converts, they sell preferred stock, and they use that to buy it. The first bit of Bitcoin appreciation is accretive to shareholders, and then the buyers of the preferreds or the zeros, they either get just upside participation thereafter. Oftentimes they are in a class of investors that otherwise might not get exposure. I pointed out the high yield investors would have an interest in those kinds of instruments. A small amount does a lot for a fixed income book. So that is certainly an area of interest. But yeah, we'll talk about that a little bit more because it is a more in-depth conversation. And what is a convertible? A convertible is simply a bond with an embedded option. So it's something we're very, very interested in here on Open Interest and at the Options Edge, where we write about these topics. But it should be of interest to anybody who trades in the option space because you want to always know, okay, well, you're senior in the cap structure, you're getting an option, is it a good priced one? I guess we'll discuss that when we come back on Wednesday. So I hope you'll join us then. Thanks for watching.